Hey guys, so today I'm going to be discussing 5 ETFs that in my opinion are some of the best ETFs to buy on the market right now for high growth. So for those who don't know what an ETF actually is, an ETF is an exchange traded fund that is put together normally by a fund manager and they pick a number of different stocks, normally across a specific sector or subsector, and they pick these stocks based on the performance that they believe they're going to achieve in the near future. So normally the fund manager picks the stocks that they think are going to do well, and as a normal investor, you get to buy a portion of this pie on a publicly traded exchange. So these 5 ETFs that I picked out today are across different sectors that I believe are going to have a lot of growth come in the near future, and therefore I believe that these are great buys right now if you want to achieve a lot of growth. So I will just say, guys, before we get into it, this is purely my own opinion. So I pick these stocks based on what I believe is going to do well in the future, and that is definitely not factual. I'm not a financial advisor at all, so you should always definitely do your own research before you look to buy a ETF or a stock. So remember to leave a like and subscribe if you do enjoy this video and you want to see more videos from me in the future. And let's get right into the video. So first up, we've got the ARK Innovation ETF, which is the ARK-K ETF. Now this ETF has a 12-month return of 148%. It has an expense ratio of 0.75%, and they currently have $4.8 billion of assets under management. Now in this ETF, there are 46 different companies in total, with the weight of the top 5 holdings combined being just under 37%. Now these top 5 holdings are Tesla at 10.28%, Invitae Corp at 8.9%, Square at 6.59%, Roku at 5.61%, and CRISPR Therapeutics at 5.22%. So this fund is diversified very well across a wide range of sectors and subsectors. So the main overall sectors are healthcare at 36.6%, IT at 31.7%, and communication services at 13.2%. So Cathie Woods is the owner of ARK Invest, and both are very highly respected in the investment world for their brilliant stock predictions and fund performances. Now Cathie Woods is the portfolio manager for this fund, which definitely gives investors great confidence in future returns. Now 0.75% is relatively high for an expense ratio of an ETF, especially compared to other ETFs on the market right now. However, I believe it is worth every penny. So the ARK-K ETF is one of the highest performing ETFs on the market right now and has outperformed almost every other fund in the world, achieving a 12-month return for their investors of 148%, which is really incredible. So the ETF will give you exposure to some of the most innovative companies on the market right now, all in great positions to majorly disrupt the industry that they're in. So the companies in the fund rely on or benefit from the development of new products or services, technological improvements and advancements in scientific research, industrial innovation in energy, automation and manufacturing, and the increased use of technology and infrastructure and services across the world. So it must be said that a lot of the companies in this ETF do definitely have a lot of risk to them. However, some companies have absolutely massive growth potential over the next few years. So personally, I do believe that some of these companies in this ETF do have potential to make 10x their valuation in the next 2 to 3 years. So as I've already mentioned, it is one of the highest performing ETFs on the market right now, and I believe it is perfect for someone who has a quite high risk tolerance, but also wants a high growth potential across a variety of cutting edge, innovative companies. So next up we have the iShares Global Clean Energy ETF with the ticker symbol ICLN. Now this ETF has a 12-month return of 95%. It has an expense ratio of 0.46%, and they currently have $2.08 billion of assets under management right now. It does also return a nice dividend yield of 1.01%, so that is definitely a bonus for a relatively growth-orientated ETF. So this fund does consist of 30 companies in total, with the weight of the top 5 holdings combined being just under 36%. So these top 5 holdings are Sunrun Inc. at 7.8%, Plug Power at 7.5%, Xinyi Solar Holdings at 7.1%, Solar Edge Tech at 7.1%, and Enphase Energy at 6.5%. So all of the companies are clean energy based, hence the name, but the fund is geographically diversified across the globe, with the US making up 43.4% of the fund, China making up 14.41%, Canada making up 6.46%, and the rest of the world making up the remaining 35.7%. So even though there are a lot of US companies in this fund, there is quite a nice diversification across other countries around the world. So in 2019, around 11% of global energy came from renewable sources. It is predicted that by 2050, 50% of the world's energy will come from solar and wind energy alone. So this is quite a staggering shift in the global energy source pattern. So the ETF covers all types of upcoming renewable energy types, including solar, wind, biofuel, geothermal, hydroelectric and fuel cells, which gives you a great exposure to the entire renewable energy sector rather than just one specific type. So governments across the world need to continue to invest in clean energy in order to achieve their environmental targets that they've set. So it is estimated that almost $2 trillion worth of further investments are needed to be made by 2030 in order for governments to reach the targets that they've set for themselves. So with a large increase in spending, the renewable energy companies are in a great situation to benefit from increased revenue and increased profit. So I believe Biden is currently the favourite to win the US presidential election and has promised that he will act on climate change immediately if he gets into power. And he has also created a clean energy revolution plan. So I believe that if Biden does win the election, this would be a catalyst for more clean energy and a catalyst for price growth for this particular ETF. If Trump does win, on the other hand, I think we could see a bit of a sell-off. However, if you are going to be holding for the long term, then I don't think it really matters too much, because clean energy is going to be a constant factor in government plans for the next decade or so. So I think there's definitely a need for clean energy regardless of who wins the election. So next up we have the iShares Semiconductor ETF with the ticker symbol SOXX. Now this ETF has a 12-month return of 54%, an expense ratio of 0.46%, and it has $3.8 billion of assets under management. It also has a dividend yield of 0.79%, which is definitely quite nice to have. So there are 30 companies in this fund, with the weight of the top 5 holdings combined being just under 40%. Now these top 5 holdings are Broadcom at 8.2%, Intel at 8%, Texas Instruments at 7.95%, Nvidia at 7.9%, and Qualcomm at 7.8%. So it's quite a straightforward breakdown for this one. Semiconductors make up 80% of the fund, while semiconductor equipment makes up 20% of it. So semiconductor technology is used in a wide range of technology and digital services, including the chips we use in our smartphones today, CPUs for computers and laptops, LED bulbs, TVs, and many more. In addition to this, semiconductors are used in bank operations like ATMs, train networks, internet infrastructure, 4G and 5G infrastructure, as well as advanced driver assistance systems and full self-driving. So many semiconductor companies have high revenue growth and high profit margins on their products, and due to the global pandemic, tech usage is at an all-time high right now, and the tech sector in general is likely to continue to keep growing over the next few decades. So this does mean that there is going to be a constant demand for semiconductors, which does show no sign of slowing down anytime soon. So the semiconductor sector does have some sort of risk associated with it, and the stocks can be somewhat volatile. So an individual company's stock can soar or drop depending on an announcement of a new product or a rival product, or if they win or lose a large contract, such as with a phone manufacturer. So for example, if a individual semiconductor company has a license and a contract to produce a phone chip for a certain type of phone, and they all of a sudden lose this contract to a rival semiconductor company, then you're going to see a big drop in one company and a big rise in the other. So this means that there is quite a lot of volatility associated with these sort of companies. And this is why investing in an ETF like this one is a great way to diversify your holdings in the semiconductor industry to nullify any sharp declines that might happen. So theoretically, as long as the semiconductor industry as a whole keeps on growing, then this ETF is going to continue to go up, regardless of individual companies dropping off or going up in price. So if you believe that technology and tech usage is going to continue to grow, then this semiconductor ETF could be a good pick for you, especially if you are willing to take a little bit of a risk for the potential of high growth. So next up we have the WISDOMTREE Cloud Computing ETF with the ticker symbol WCLD. Now this ETF has a 12-month return of 96%, an expense ratio of 0.4%, and it does have $308 million of net assets under management, which is on the smaller side, but I do still think it's a good ETF. Now there are 54 companies in this ETF, with the weight of the top 5 holdings combined being just over 12%. Now these top companies are Zoom at 2.76%, Fastly at 2.4%, Cloudflare at 2.38%, Sprout Social at 2.3%, and Paylocity Holdings at 2.24%. Now all of the holdings are cloud-based companies, but the fund is very heavily weighted towards US companies, with 94.7% of the fund being weighted towards them. Now this is obviously not very diverse, and this could be a problem if you're wanting to have a geographical diversification, but obviously the US is a strong economy, so I don't believe it's too big of an issue. So cloud computing services is a fast-growing sector, with the growth of many companies being increased rapidly due to the worldwide pandemic. So global revenues from this sector are forecast to increase from around $250 billion per year in 2020 to $364 billion per year in 2022. So many large companies are starting to identify the benefits of the cloud, and they are utilizing the cloud-based software, platforms and infrastructure services in order to make their businesses more efficient. So all companies added to this ETF by WISDOMTREE need to have at least 15% annual revenue growth for the last 2 years. So a lot of companies in this ETF are growing extremely fast. So the rapid growth of the cloud sector does come at a cost. So there are a number of cloud companies with high valuations right now that have a relatively low revenue and are not making profit right now. So the fact that there are many companies in this ETF that are still in their infancy and have a lot of room to grow does inherently bring some risk to it. Now there are a number of things that can go wrong for these companies on their journey to achieving the super high growth potential that they have. So it's a little bit of a high risk ETF to invest in, because the companies are quite early on in their lifespan and there could be problems down the line. But obviously there's a very high ceiling for a lot of these companies. So our final ETF today is the Vanguard Information Technology ETF, ticker symbol VGT. Now this ETF is more of a broad holding rather than a specific industry, and it does have a 12-month return of 54%. The expense ratio is very low at 0.1%. They have $43.9 billion of assets under management, which is extremely high compared to the others. And the dividend yield is 0.82%, which is definitely not too bad. So this fund does contain 328 companies, which is a lot more than the others. And the weight of the top 5 holdings combined is just over 50%. Now these top 5 holdings are Apple at 23.2%, Microsoft at 16.8%, Visa at 3.5%, Nvidia at 3.4%, and MasterCard at 3.3%. So although all holdings are tech-based companies, this ETF is still very diversified across the different tech sectors. So tech hardware and storage makes up 24.3%, systems software makes up 20.5%, semiconductors make up 14.6%, data processing is 13.9%, and application software makes up 13.7%, and then a variety of other sectors make up the remaining 13%. So as you can see, the assets in this ETF are very diversified over the different subsections of technology. So this ETF is great for those who want a very broad exposure to a large number of tech stocks across a wide range of tech sectors. So with that being said, despite the fund consisting of over 300 different companies, the top two, Apple and Microsoft, are heavily influencing the overall performance of this ETF, with their combined weighting being 40%. Now this is good for someone who likes the two companies, but if you're not convinced that these two companies will continue to grow at a decent rate, then this ETF might not be the one for you. So the dividend yield of 0.82% is not especially high, but a number of companies in the ETF have very high dividend growth rates, particularly some of the main holdings like Apple, Microsoft, Visa and MasterCard. So you might start off with a 0.82% dividend yield when you first buy the ETF, but over time this yield is almost certainly going to increase at a pretty fast rate. So the 5-year dividend growth rate for this ETF is a very attractive 18.3%, which is obviously something that is good to have, especially if you are a dividend investor. So the world is heading towards more tech, especially due to the new ongoing pandemic, and technology companies are likely to continue to thrive in the future. So if you are bullish on technology and don't want to pick specific companies or a specific sector, then this ETF is a great option to get exposure for a wide range of different tech companies. And yeah, overall I think it is a pretty solid ETF to have. So that is all for today's video, guys. I hope you all enjoyed watching this. I do also just want to remind you that I'm not a financial advisor, and this video is for purely entertainment purposes only. These ETFs that I picked out are just ones that I personally think are quite good and I like the look of them, but that might not be the same for you. So you should definitely do your own research into them. Make sure that you know exactly what you're getting yourself into if you're going to be investing in one of these. And yeah, you definitely need to do your own research into these companies. But apart from that, remember to leave a like if you did enjoy the video. It really does help me out a lot. Be sure to leave a comment, let me know what your favourite ETF is from this video. I'd be really interested to know what you think. And also remember to subscribe if you want to see more videos like this in the future. And apart from that, guys, thanks a lot for watching.